Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to go over the difference between annuities versus IRAs. So I'll help you make a decision which route to go. So when you buy, here's the difference. Okay, an IRA, everybody knows what an IRA is, right? An annuity is a vehicle that can be used for several different. It's a solution to several different types of problems. Okay. Where the IRA is more of just like putting money away and saving for retirement and having it invest and grow it over time. And then at retirement, you figure out how to spend that IRA and make it last for the rest of your life. Okay. With an annuity, you're looking for tax deferral, just like an IRA. You're looking for principal protection, and that's usually through a fixed or fixed index annuity. You're looking for contractually guaranteed lifetime income. So income that you will receive even after the account has been spent down to zero. Lump sum death benefit, long-term care benefits, life insurance alternative, the ability to earn stock market index returns without having to lose money to a stock market crash. There's all kinds of different reasons why a personal pension plan. Most employers don't offer pensions anymore. So this is a way that you can contractually guarantee your future retirement income. So there's no guesswork that you will receive in an IRA. When an IRA is advantageous, you're using mutual funds, ETFs, stocks and bonds. You could use IRA CDs. You could do cash or money market funds, right? You're using this for the typical reason. Hey, I want to stash money away. I want the tax deduction, right? And I want to grow it and just keep adding to it each and every year. And then after 25, 30 years of working and I'm ready to retire, okay, I've got this nest egg that's been built up. And then you figure out whether or not how you're going to take the income distribution from it and maintain the IRA balance while still taking income from it to supplement your income. There's an easier way if you're going the IRA route. Okay, so you can transfer your IRA into an IRA annuity, and you can get the contractually guaranteed income now or in the future. And it's one of the most popular ways of funding an annuity is through using IRA money, right? So if you ever wanted to do that, you can do that at any time. With annuities, if you're comparing non-qualified annuities as opposed to an IRA annuity, with the non-qualified annuity, there's no contribution limits, right? So you could contribute as much as you want to the annuity and get that contractual income in the future, and only the interest is going to be taxed in the future, right? Everything with a non-qualified annuity is going to be funded with after-tax money. Okay. Right now, speaking in May 20th, 2026, when I'm recording this video, I think the big difference is because the annuity payouts are so high. We're at the highest. This is the optimal time to be buying an annuity, whether you're in your early 40s or you're 60 years old, because the payouts are ridiculously high compared it's the highest payouts since the 1990s. Let's just say that, right? It's the highest it pays to its customers in 25 to 30 years, sometimes maybe longer than that. You're talking about 8%, 9%, 10, 11, 12, 13% plus payouts for the rest of your life, right? And because of that, and because of the contractual nature of the annuity, you can guarantee what your income is up to like 30 years in the future. Okay. And you will end up getting your original investment paid back to you in a matter of like 4 or 5 years. So for example, if you're 40 years old and you put, let's run a calculation here. Do I have the calculator here? Scroll down to this page. All right. So let's just say I'm 40 years old and we're in Georgia. We're licensed in all 50 states, but we're out of Georgia. And I just put, let's say I have $1 million just for easy math. Okay. and I want to start my benefits after 20 years at age 60. We're going to go add the math problem. We're going to let it churn. These are real-time quotes, by the way. So if I'm looking at this, if I'm 40 years old and I had $1 million, I'm contractually guaranteed $228,565. Okay, I'm going to get my money paid back to me in less than 8 years. That's a pretty good deal. Then the rest of it, you're pocketing the insurance company's money, right? So if I wanted to go back, and let's just say I didn't want to put $1 million in, and I wanted to make $100,000 a year starting at age 60. Let's see how much you would need. I'm going to put in 400,000. I'm 40, Georgia, and I want to start it in 20 years and 9. And I'm going to get my call. Let's see how much 400,000 would pay me. Okay, so just under $100,000. So my gut would tell me you're going to need about 425, 450. And then if in your head you think, well, $100,000 a year for the rest of my life would be enough to live off of in retirement, and I get to retire as early as age 60, $400,000 is a fraction compared to if you had a money manager manage your money. You would need about $2.25–2.5 million ish grown in your nest egg to get $100,000 using their 4% withdrawal rate rule. Most financial advisors, when you're ready to retire, they're going to look at your nest egg and they're going to give you 4% of whatever that value is, and then adjust for inflation thereafter, right? So you could use $400,000 today and get the same outcome it would take $2.25–2.5 million, right, for retirement income. So I bring that up. The annuity payouts are extremely high right now, and you could retire comfortably at a fraction of the cost. Shoot, if you're nearing retirement, let's just say you're 55. We'll do 55 here, and we'll put in $1 million, and we want to retire in 5 years at age 60. Okay, so if you had $1 million and you were using a financial advisor or a money manager, they would advise you to take out $40,000 in the first year, and then you're going to adjust each and every year based on the inflation rate, right? And then the fingers crossed that you're going to hope that it lasts you 25, 30 years. With this, it takes all that out of the guesswork. You're contractually guaranteed the same or better income for the rest of your life, even after the account runs down to zero. And if we're looking at here at $1 million, where I would get $40,000 a year out the gate with the same $1 million, here you're getting, I wouldn't go with a B+ rated company, but if I'm looking at A-, $103,147, more than double the income out the gate that you would having somebody manage your money at one of these big box advisories. I mean, that's a no-brainer. $103,147 for the rest of your life. I mean, come on. So using an annuity, probably the way to go. If I'm going back to hey, well, I got the investments, and this is more for the folks that are nearing retirement and don't want to take on the risk. If you're looking at mutual funds, if you're looking at mutual funds, you could look at a fixed index annuity as an alternative. This way you can earn interest based on a stock market growth like the S&P 500 without losing money. You'll probably get a better return with mutual funds, but you're taking on all the risk. ETFs, maybe not. Bonds, definitely competing with bonds. CDs, the MYGAs pay higher interest rate than CDs. Same with cash or money market funds. Your MYGAs are right now giving between 5 and 6.30% a year guaranteed for the entirety of the term. So it really just depends on where you're at in life. The IRA is an awesome tool, and by the end of this video, if you're not sure, consider the IRA annuity. You get I would be lying to you if you say you get the best of both worlds, because if you just have a traditional IRA and you're investing it, you're going to get more upside than an annuity, or excuse me, more than an IRA annuity. But if you're at a place in your life where you don't want to take on the risk, the IRA annuity is a far better option than the regular annuity. Just trying to think what else here that you have to know about. The IRA, if you have a non-qualified annuity, there's no RMDs at age 73. There are with IRAs. Only the gains are taxable in non-qualified annuities. You're paying taxes on all of the withdrawals from the IRA. Get more liquidity if you have the typical IRA. With the IRA annuity or a non-qualified annuity, you're going to get up to 10% a year annually without a penalty. That's usually a standard. If you're younger, I would tell you, unless you have a lot of money, go with the IRA. So let's just say you got a 9-to-5 job and you're stashing money away for retirement. A traditional IRA is far better than an annuity. If you've got a lot of money and you're successful in the sense of money, an annuity might be a better off deal because you could put in larger chunks to get a guaranteed income and retire comfortably at a much lower amount of money, right? Let's see. I think that's it. If you wanted to, you had an IRA and you wanted to get it out of the market because the market's volatile like it is now, you could move it into an IRA MYGA or an IRA fixed index annuity, let it sit outside of the market and wait till the market stabilizes. And then maybe in a couple of years, you could put it back in a traditional IRA. So yeah, I think those are the pros, the cons, the differences. If you got any questions about it, leave a comment below. If I missed something, leave a comment below. And if you need a free comparison, contact us at the Annuity Expert. We've got the largest selection of annuity products in the United States. And we'll help you find, at the minimum, we'll help you make that decision. Hey, which is better, the IRA or the annuity? Okay. And if the annuity is not a fit, we will tell you that. We want you to be in the best possible scenario for your specific situation. So yeah, contact us over at the Annuity Expert, and we'll catch you on the next video. See ya.